Hi, my name's Markus. I'm head coach at Rockwell Trading, and in this short video, we're going to talk about buying options, and more specifically, the magic of delta. It's a secret for many new traders, and I want to share it with you because it's a very powerful concept. If you're new to trading options and you've never bought calls or puts, then this is an important video for you. If you've started by buying calls and puts, but you're still a relatively new options trader and you've been frustrated with how an option moves based on a move in the stock, then this is definitely a video for you. It's actually a very typical problem for new traders where they might be right on the direction of the market and the stock that they're trading, but then they're not getting the movement in the option that they would expect. And it all comes down to delta. Delta is important, and delta will help us understand how an option is likely to move. So let's take Disney as an example. The ticker is DIS, and I have a chart here showing the power crossover method indicators, which is a strategy that we use here at Rockwell Trading to identify swing trading option or swing trading opportunities in stocks or options. So technically speaking, we had a buy signal here on May 1st, and so it's a little late in this move, but with all three indicators still bullish, we're going to use this as an example for today's discussion, and we can use this 81.09 price, which was the last price that Disney traded at today, for reference when we look at our options chain. So let me bring up the options chain here. We have the June 2014 calls, Disney trading at 81.09, and we have strike prices between 72.50 and 90. So with this options chain here, many new traders are instantly drawn to these lower priced options, 96 cents or 33 cents or 11 cents. Now keep in mind that when you buy one option, you actually are going to multiply that price by 100 because that option represents 100 shares. But instead of paying $8,100 to buy 100 shares of stock, buying one call option and controlling this stock for $96 or $33 or even $11 is very attractive, thinking that, hey, if we get a big move and I'm just paying this small amount, then I could have a pretty nice trade-off and be rewarded for a big move with a small investment. Well, that's true, but this is where many new traders really struggle and get frustrated because they don't understand how the option is likely to move for every dollar move in the stock. And this is where delta comes into play, because the delta represents the potential increase or decrease in an option for every $1 increase or decrease in a stock. So as an example, if we're looking at calls, we have deltas between 0 and 1. And if we look at the 75 strike here, I put my mouse on the detail tab, we see that the delta is 96. So with a delta of 0.96, this is telling us that based on the information that we have right now, in theory, if the stock goes up $1, the option should go up 96 cents. The opposite is true. If the stock goes down $1, in theory, the option should go down 96 cents. So now we have a better understanding of how this option is likely to move based on movement in the stock. If we go out to this cheaper out of the money option, this 33-cent option, and we look at the detail, we see that the delta is 16. So we're nowhere near a dollar for dollar move with the option in the stock. If the stock goes up $1, the option is just going to go up 16 cents, which isn't bad if you're only spending 33 cents on the option to begin with, but this is where many new traders get frustrated because they expect that the option is just going to move like the stock, and that's not necessarily the case. So delta is important for understanding how an option is likely to move, but it also is an easy reference of probability. It's not a true reference of probability. It's not an actual calculation that calculates probability, but it's used by options traders all over the world to just gauge the potential for an option to have value at expiration. What I mean by that is if we take the delta, we can use that as a probability that when that option expires, the option will have value. It might be a penny, it might be $10, we don't know. But if we look at these options, it will start to make a little more sense. Because think of an at the money option. Technically, an at-the-money option should have a delta of 50, meaning if the stock goes up a buck, the option should go up 50 cents. If the stock goes down a buck, the option should go down 50 cents. And with a delta of 50, if we use it as a probability gauge, and that at-the-money option has a chance of being value or having value at expiration, and that probability being 50%, it's true, right? Because if it's a true at the money option, there's a 50% chance it could expire worthless or have value. And then if we look at these deltas that are deeper in the money, we see that the 75 strike with a delta of 96, this is saying that if we use this as a reference point, 96% chance that the option could have value at expiration. Well, that's probably true because we'd have to see a decrease of $6.09 in 31 days for it to actually lose all of its value. So if we take this deep out of the money option and we look at the delta of the 85 strike and we see a delta of 16, with a 16% chance that the option has value at expiration, that's a pretty aggressive trading decision, right? If we're looking at these low deltas that might be cheap, but they don't really move a whole lot when the stock is moving. Here, a delta of 6, and we now understand that the likelihood of that option having value at expiration, then we're probably going to be a little more conservative, pay a little more for the option, and give ourselves an opportunity to participate in that market move. Now, it doesn't mean that out of the money options can't be an option buying strategy, because it is. It's just a strategy where a trader is going more for that home run trade, that big win every now and then, and not a high percentage strategy where they're expecting profits all the time. Now, this is what I like to do as an options trader. If I'm looking for that home run trade, I like to have a delta of around 25. If in theory 1 out of 4 trades will have value at expiration and I'm using a strategy like the power crossover method, then I'm giving myself a chance to participate in a nice move and try and hit that home run every now and then. It's not going to happen every trade, but even 1 out of 4 could be very rewarding if we get that big move. If I'm trying to trade a stock and I really want to have that dollar for dollar movement where my goal is stock substitute, where I'm buying an option just to replace the idea of actually buying the stock, then I would look for a delta of 80 or higher. For most of the trading that I do, though, when I'm looking for some short-term moves and I'm swing trading options, I would look for a delta of around 60. With a delta of around 60, you have a slightly in the money option, so there's already value priced into that option, and you're getting some nice movement in the option price if the stock is moving as you would expect it to based on your analysis. So, what you learned today: delta represents the change in the option price for every dollar move in the stock. It is not static. It's not constant. It is a value that changes. So it could change every day theoretically, but it helps us understand how an option is likely to move so we are prepared for that movement before we ever get into a trade. It also helps us understand theoretical probabilities for an option to have value at expiration. Again, it's not a probability calculation, but it's a very simple tool just to gauge yourself to determine how aggressive or how conservative you're being as a trader. And if you like the idea of buying out of the money options, but you're going too far out of the money and your deltas are too small, then try to buy an option out of the money that has a slightly higher delta, because that could be the difference between options that are expiring worthless and options that are expiring with value. So that's going to do it for this video. I hope you learned a lot about buying options in under 10 minutes, and I hope that you are able to be better prepared when it comes to buying options, because it's a great vehicle for trading.